This lesson is on policies to promote economic growth. Economic growth is a rise in an economy's output, or real gross domestic product. The two categories of policies for promoting economic growth are demand-side policies and supply-side policies. These policies are aimed at increasing aggregate demand or raising the economy's productive capacity. Demand-side policies are policies that increase total demand or aggregate demand. Aggregate demand is the sum of consumption, investment, government spending, and net exports. A rise in any of the components will increase the economy's output. For example, a rise in consumption will encourage businesses to increase their output to meet the demand, thereby causing economic growth. Demand-side policies are divided into two, namely fiscal policy and monetary policy. Fiscal policy is the use of taxation and government spending to influence total demand. To promote growth, the government can reduce taxes or increase government spending. This is known as expansionary fiscal policy because it increases aggregate demand. If taxes are reduced, consumption will increase as people will have more disposable income. In addition, a tax cut will mean businesses will have more profit for investment, which would make more goods available, thereby causing economic growth. Increased government spending is capable of boosting economic activities. For example, spending on healthcare or education would make workers more productive, which will increase the output of goods and services. Monetary policy involves the use of interest rate, money supply, and exchange rate to influence aggregate demand. To promote economic growth, interest rate is reduced, money supply is increased, or currency is devalued. Reducing interest rate makes borrowing cheaper for consumption and investment. More consumption and investment mean more products will be produced, resulting in economic growth. The money supply will rise if the central bank allows commercial banks to keep a smaller proportion of their deposits as reserve. This will increase the amount the banks give out as loans to individuals and businesses. Consumption and investment will rise, and by extension, the output of goods and services. When a currency is devalued, exports are cheaper while imports are more expensive. Consequently, exports increase while imports decrease. Net exports, that is exports minus imports, increase. Rise in net exports means more goods are being produced in the economy, causing economic growth. Supply-side policies. These are policies that increase an economy's productive capacity. Productive capacity is the maximum output an economy can produce. They include provision of education and training, provision of infrastructure, promoting research and development. Education and training improve skills of the workforce and make them more productive. Infrastructural facilities like road would aid productive activities. Research and development helps create new products or better ways of producing. Businesses can fund production and expansion through financial infrastructure like stock exchange and banking.